People that were willing to pay over $150 a share for the stock are actually getting a better deal now that streaming is becoming more efficient and the parks are running pretty strong. Bank run fears still on the table. US default still on the table. And who knows what the Feds are going to do. And the markets are fairly flat on the day, but today we're specifically going to talk about Disney. With the recent earnings on the table, we see a huge collapse in Disney, and is this going to be a buying opportunity? The subscriber counts are shrinking, and the streaming business is getting more and more competitive each and every day, starting to approach pandemic levels, multi-year low pandemic levels. This is obviously a company we're all familiar with, including my wife, as we did get married on Disney, and we go all the friggin' time. So I am definitely a customer, but does that mean it's a good investment? Let's get into it. What we're going to do today is go over the quarterly report. I'm going to give you guys what I personally think. Disclaimer, I do have a $75 price target on the stock. So first thing right off the bat, we see that top line revenues coming in very strong. 13% growth with a company this size is extremely impressive. And when we go through the trailing 6 months here, and so when we bring it down to a net income, we can see that Disney is heading in the right direction as far as their net income goes. To run the parks and the amount of debt Disney has, this is an important metric here. We want to see the free cash flow growing. It's exactly what it's doing. Now, still negative for the year, but we can see that it is heading in the right direction. And the other thing you got to really like about Disney is the fact that when you're buying this business, you're buying multiple businesses. Now, the one thing I do not like about Disney is it's all based on, in my opinion, a very strong economy. You want the consumer to remain strong, have plenty of discretionary money in order to go to the parks, because that's really where the bread and butter is. And to me, the streaming side is actually getting more efficient, even though they did lose subscribers. And so when we're going through each segment, the one segment that, is going to really stick out is going to be the Disney Media Entertainment Distribution, specifically the linear network. So in my opinion, where the street is really focused is two areas. They want to see subscriber growth almost at any cost, it seems. So while the subscriber growth is not happening, they're getting closer to making this more efficient, which I actually like, because I do think we're getting a softening in economy and people are starting to make some choices here. They'd much rather go out and do things instead of pay for services and products. So here's where I think Disney's biggest problem is, and where I think we're going to see some headwinds going forward. Number one is going to be consumer products. As I stated before, people are paying up for experiences, and when we look at consumer products going down 14% and 23%, that's a substantial amount of money that comes down to the bottom line. Look at the explosion that the stock had, basically moving up nearly 100% and now round tripping back to where it was pre-COVID levels. So here's the interesting thing. During COVID, this was a very expensive stock, especially when we think about the rally that it had heading into the streaming worlds. And now it's round tripping back when streaming is becoming close to being profitable and the parks are actually performing better than they were. This is where it gets interesting and where I think the valuation's starting to settle in. So the question now becomes, can the parks remain strong while streaming is getting fixed? And that's where I have a concern here, because if they're not free cash flowing, there's a lot of liability with this company, a lot of overhead with the company, but they are being proactive. They have made layoffs. They're getting streaming prices more stabilized. So if they are able to regain subscribers, this is really going to boost their business, especially if the parks can remain strong. But it looks like they're going to do right around $85 billion in revenue. If we annualize out roughly $20 billion for the next couple quarters, that'll put it at $85.3 billion for 2023. And I actually have them sitting right at $90 billion. So I'm pretty much in line, which means that I don't think I need to change anything. I don't think I need to redirect anything. If anything, getting down to these levels, I might have to wait until more market turmoil takes place, but I do think there's going to be an opportunity to buy Disney with a 7 in front of it. And at those levels, I definitely think it's worth taking on the risk because of the well-diversified business. And I do think they can get through the hardship of a recession. They have global exposure. So if the US goes into a recession, they do have other parks that can make up for that. Along with that, streaming is getting more efficient. And when we look at it from a big picture here, people that were willing to pay over $150 a share for the stock are actually getting a better deal now that streaming is becoming more efficient and the parks are running pretty strong. And so for me to hit my price target, I would actually start looking at Disney with another 10 to 15% drop here. And that's basically going to put it in my wheelhouse of where I had the price for the last year. And so that's where I stand with Disney, guys. I see the business actually becoming a little bit more efficient. I see the free cash flow growing, which is going to help with debt, and that'll eventually help with their bottom line. So longer term, I think we're going to hit my price target around $75. And I think at these levels, it's a tremendously interesting buy because you have so many aspects of their business, whether it's hotels, cruises, streaming, that buying this one company, you do have a pretty interesting diversified consumer discretion type of business, which you definitely want to own coming out of a recession because the price in Disney is probably going to get extremely depressed. The news is going to get bad. And this is when you want to buy it when you're coming out of a recession, because once we get stimulus or once we start getting the job market back to normal, this is going to be a company that should do extremely well as the efficiencies are picking up now that Bob Iger's back. So as always, ladies and gentlemen, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one.